Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky. And as always, we've got Bill Keen and Matt Wilson. Gentlemen, how you doing today?
Well, we are doing really great here, Steve. And I always like hearing you say that. Sometimes I just re-listen to the intro to our podcast. I hope you remain our podcast co-host for, many, many years to come.
Mm-hmm. Yeah, that's the plan.
Okay.
My retirement plan is banking on it.
Okay, very good. Very good. Because as we've shared with our listeners in the past, you are Social Security age, but because, you work with us and some other fine work that you do, you haven't had to turn that on yet. So
That's right. But I'm not Medicare age. I'm in that in-between gray zone. Social Security, yes. Medicare, no.
That's right. That's right. And I'm creeping up on Social Security age, but I hope not to take it for many years myself. So, yep.
Well, good. Well, we have a couple of things we're going to be chatting about here today. So one of them is, Bill and Matt, I know you guys just hosted an event there at the Keen Wealth Advisor facilities there in the great Kansas City area. So what did you guys have going on at the office here?
Yes, we did. Well, Steve, you've seen our nice location. I have gotten used to calling it our new headquarters, our recently built out headquarters. Well, it's been over 2 years now since we've been in our new space. It's a 20,000 square foot footprint, the entire 10th floor, one of the top floors of the Lighton Tower here on the corner of College and Metcalf. If you're from the greater Kansas City area, you'll know that's a kind of a well-known kind of interchange, if you will. And we really enjoyed demising the space, taking it over and making it really welcoming to our guests and team members and to ourselves when we come to work each day with fabulous views, 360 all the way around, and a beautiful time of year we just came through as well with the trees turning. But so in the build out, we made room for, a nice welcoming lobby and I think 8 separate conference rooms, one including a very large education and training room adjacent to a really nice kitchen and lounge area, allowing us to do events here. And in the past, I've had someone on the podcast with you all called Anthony Fasano. Anthony Fasano runs something called the Engineering Management Institute. And when my book came out initially 5 years ago, and then the recent update a few years ago, I was on his podcast. I think I've been on his 5 times. But his objective is he's a service provider to the architecture, engineer and construction industries, and he provides trainings on all aspects of becoming a better leader, becoming a better project manager, and he does work nationwide with a lot of the same companies that we actually advise their clients on their wealth management issues and retirement planning. So there's a real interesting kind of collaboration that we have with Anthony's company, the Engineering Management Institute. So Anthony had an idea of having a training meeting where he brought project managers together from all over the country. I think we had people in from Ohio and Matt, Seattle, Detroit, a couple other states, plus obviously a lot of local PMs came. And we had what he called the AEC, Architecture, Engineering, Construction, PM Project Manager Connect session, where he brought in speakers. He was the moderator. He's very intelligent himself. He himself is an engineer, and panelists. And we had breakout sessions, and they from about 8 till 5:30 had a wonderful session of collaboration and learning. It was a spirit of abundance, not of scarcity and competition. It was people from different companies coming in, sharing best practices, and really collaborating on discussions around how to be better at their crafts. That was followed by a reception from 5:30 to 7:30 where additional AEC leaders came and enjoyed some food and drink and just milled about and got to meet and talk with one another. It was quite an event to hold here at our headquarters. It was very well received. The responses are coming back to the to the surveys that went out after, and I'm hearing from Anthony and his team that it was looks like there's going to be one on tap for 2025, and we're honored to host it again here at the Keen Wealth headquarters. So, we, as you know, we work with a lot of engineers. We work with folks that are not engineers or employees of engineering firms also, but we do have a very deep niche and understanding of what engineers are facing when they approach retirement and how they think and the standards of which they like to operate to. So really cool collaboration we had there, and grateful to be able to use our new-ish space to host.
Mm-hmm. Yeah, and that was great that you guys had the foresight to think about that and have that kind of educational space, because I know one of the key things of Keen Wealth Advisors is the education components. And that's one of the reasons why we do this podcast, is because we're about education, and we think smarter investors are better investors. And that can extend to the type of training that you just mentioned there with Anthony. So appreciate you sharing that.
You're welcome, Steve. I might mention, I cannot forget. You won't forget. We've had a lot of incredible guests. Every guest we've had has been wonderful. One of our really awesome, and in the spirit of the engineering world, guests we had was former CEO of Burns & McDonnell and best-selling author Greg Graves. Was on our show several years ago when he was releasing his book, Create Amazing. And I was able to place a call to my good friend now, Greg Graves, and ask him, could he possibly make a stop by at the tail end of our program? Now, this wasn't impromptu. I called him months ago and got him on the calendar. But he came by and he gave an incredible talk to the project managers and those in attendance about the power of teamwork, about the power of project managers, and how project managers are essentially CEOs of their own projects. And a lot of the things that he shared about to look out for, to look forward to, and to be a better project manager. He did a fantastic job closing out the days-long training session too, Steve. So I thought I would make sure and bring that up. And Greg, if you're listening, I know you say you do, thank you so much once again for taking the time to come out with us.
Excellent. Yeah. And we should link to Greg's episode in the show notes here. So you'll be able to find that there. All right. A couple other things here. One is the main thrust of today's episode is going to be about ways to lower your taxes here in 2024. So as we're having our conversation today, it is early November. And of course, we have November 5th is an important date that we've all been hearing about. We're actually having our conversation prior to November 5th. So we don't know what the outcome of the election is. But Matt, maybe you want to speak to that for just a moment here.
So post the election, we will have our next episode following this one, where we will talk about the results of the election and our views on policy changes that would impact our clients. And kind of on today's theme of, year-end tax planning moves that you should consider over the next couple of months. Well, what are taxes going to potentially look like in 2025 and beyond? So we'll talk about that on the next episode.
And Matt, you're assuming that we will have the results of the election in by our next episode, which, who knows?
Yeah, I decided I didn't want to bring that up because most people are afraid of that. So
okay, all right.
Hope it's we don't have to worry about that.
Yep. All right. So Matt, why don't we dig in here in terms of some ways to lower the tax bill here in 2024? What are some potential moves here?
Sure. Yeah, there's not a whole lot of time left, but there are still things you can do to minimize your tax bill in 2024. First and foremost, while you're still working, and for most folks, you have access to a retirement plan at your employer, such as a 401k. And number one, minimize your tax bill, especially if you're putting in pre-tax contributions. Make sure you're maxing that out, or at least funding it to the amount that you should be funding it for. Hopefully you have a financial plan in place to indicate to you how much you should be saving and maximizing that amount. In 2024, the maximum 401k contribution is $23,000. So that's up from last year, and it's going to go up again in 2025. There's always kind of small inflation adjustments tied to those. And then for those that are 50 and over, you also have a catch-up contribution that you can make, which is an additional $7,500 on top of the $23,000. So if you have eligibility, if you're over 50 to do that, a lot of times that's a separate, transaction inside your 401k. You have to indicate that, hey, I want to participate in the catch-up contribution. It doesn't just automatically put extra money in there, even if you're kind of overfunding it, if you're on track to overfund it. A lot of times you have to separately make that notification. So double check that. Make sure you're on track to save what you would like to save.
And Matt, does that 401k contribution have to be made by December 31st, or is that one of those plans where you can actually make it by tax day the following year to apply to the previous tax year?
Yeah, there's a it depends answer on this. In a traditional on a traditional 401k, the employee contribution definitely has to be made during the calendar year. If you have a retirement plan, if you're self-employed, you might be able to put in money as an employer, which gives you more flexibility. You can wait until tax filing time in the next year to make the employer contribution. So that's slightly different. Probably doesn't apply to most people, but I would just say, as a rule of thumb, just you want to kind of have it in the calendar.
Get her done.
Yeah,
get her done.
That's right. You can make your traditional IRA contributions or Roth contributions if you're eligible. In that same time frame, you have until tax filing time to make those contributions, which would help, especially a traditional IRA contribution, to lower your tax bill.
But Matt, just to be clear, and you were, but I guess to reiterate your clarity on this, if you are a small business owner and you have your own retirement plan that you've set up, that $23,000 if you're under 50 or $30,500 if you're over 50, that portion does need to be put in.
The employee portion has to happen during the calendar year.
That's right. But if you have one of your plans structured as like a profit sharing plan or something that allows for more, that portion then can be put in.
Yeah, anything that's considered employer. Yep.
Employer side. Yeah, and those plans, they can definitely seek counsel on that if you're a small business owner and wanting to maximize your contributions there. Or seek counsel. Anyone needs to seek counsel, right? But I suppose especially if you're a small business owner.
Excellent. All right. What's a second potential opportunity here?
Yeah, another one is tax loss harvesting. So that is the process of looking at your investments, and these are investments that are done in a non-retirement account. So this would be commonly referred as like a brokerage account or an after-tax account. Any investment that you make with after-tax dollars, like you've already paid the tax on it, you have access to the funds, you can pull them out at any time. All of that. It's a way to, tax loss harvesting is a way to look at the investments that you've made, and if you have a loss, sell the position, buy something similar, or wait 31 days. You have to have, this period of time to avoid a wash sale rule. Reinvest, if you do wait, reinvest in the exact same position, but you can lock in a loss for tax purposes. So we do this for our clients on a regular basis, where we're constantly looking at the holdings and evaluating the position and our outlook for the position. And then if we feel like, hey, we could reinvest in something similar, take that loss. And even if the client can't necessarily use it today, they can carry it forward against future gains.
Okay, so I'm going to make sure we're all clear on that. So let's say I own a stock and I'm looking at it. I've held it for a long-term carrying period over a year, and I've got a $10,000 loss in this position. Right. So you're saying I can then sell that stock this year. I can book the $10,000 loss, and then I have a couple options. So one is, if I have some other stocks where I have a gain, and I feel like, hey, maybe I want to trim a little bit of my position in this other stock where I've got some gains, or maybe it's multiple stocks where I've got some gains, that if I sell those other stocks, the first $10,000 of profit on the other stocks can go to apply against the $10,000 losses. So when I do my tax return, I have a net zero that I have to pay in capital gains taxes. Even though I took a $10,000 gain in what some of the stuff I sold, that's offset by the 10,000 loss. So zero capital gains. So that's a way of how to sell stocks that you have gains without having to pay any taxes, capital gains taxes. Is that correct?
That's right. That's right. Or if you've already realized gains, do you have any losses that you can use to offset those gains? Same concept.
Right. And then if you're like, well, hey, all my other stocks, I don't really want to sell them.
Sure.
So you can keep that $10,000 loss. You can carry it over to the next year or the next year or the next year. And then when you're ready to sell something with $10,000 worth of gains, you can apply it against that $10,000 loss that you've been carrying forward from year to year.
That's right. Yeah. You don't lose it if you don't use it. It carries forward. They do allow you, the IRS allows you to use up to $3,000 against ordinary income. So if you have a very large loss that you're carrying forward, you can, at least $3,000 of it every year can be used to offset your current tax liability. But if you do have then a big gain in the future, you can wipe that out or some portion of it with that carry forward loss.
And great to reiterate, great to reiterate that when we say people say, oh, we're losing money. Well, no, for tax purposes, you lock in the loss, but you're putting it in things like Matt mentioned that will rebound with the market, like security. So it's not locking in a loss forever. It's just for tax purposes. It's always important to remember that aspect to it here.
Good. All right. What's a third one here?
Yeah, another way is charitable giving. So one, if you are charitably inclined and you are providing funds to a charity or church or 501c3 type organization, just make sure you get those funds sent to those organizations before year end. And if you're writing checks, you do want to ideally have those checks cashed. I mean, you can always show what you've sent out if you're just writing it out of your bank account. The other kind of component to that, though, is you may not be getting a tax benefit depending on your tax situation. So what that means is that the standard deduction changed in 2017 with the passing of the Tax Cuts and Jobs Act, and it raised the standard deduction to a pretty high number that most people don't itemize anymore. So when you give money to charity, it counts as an itemized deduction. And the only way you get to use an itemized deduction is if you have enough itemized deductions to be more than the standard deduction, which everyone gets. So your charitable giving, wow, great. And a lot of people aren't doing it just for the tax benefit. But if you can get a tax benefit, let's look at that. So in some cases, we utilize donor advised funds and what we call kind of bunching strategies. So let's take a chunk of money, donate it to this donor advised fund, which then gives us a charitable deduction in the current tax year, but we have the ability to send the money to the same charities at any point, today or in the future. So that's a great tool to use. The other charitable giving strategy is utilizing qualified charitable distributions. So that is when you have an IRA and you're 70 and a half, that's a key. You have to be 70 and a half or older. You can send money directly from the IRA to a qualified charity. Can't come to your bank account first, got to go direct. And then that doesn't count as income on your tax return. The other benefit is it doesn't count. It counts towards your RMD if you're RMD age.
Is there any limit in how much you can send to that charity directly in a given year?
The maximum is $105,000 in 2024.
Is that per person, per couple?
It's per person. So you've got it has to come out of the IRA. So the IRA balance has to be big enough for one. But then if a married couple each have an IRA and they're both 70 and a half, they can each do $105,000.
Okay.
Mm-hmm.
Very good. So another good strategy there in terms of taking care of your RMD, not paying taxes on the RMD. And if you're already charitably inclined, that's sort of a slam dunk type strategy if you're 70 and a half or older.
That's right. That's right. Especially because if you're taking those RMDs and donating it to charity, well, right there, you're going to save money right on taxes. And that's a common thing that just as we're always educating clients on this, especially as they're reaching those milestone ages, and they don't realize it. And it's a great tool that, that is easy to execute on. So one thing that we do is we like to send clients checkbooks so they can just write checks right out of their IRA directly to the charity, and it's taken care of.
Now, I heard you mention the word bunching.
Mm-hmm.
So again, want to make clear that I and listeners are clear on this. So let's say that I tend to give away $50,000 a year in charity.
Yes.
And what I think I hear you saying is, and let's say in one particular year, I happen to have a really good income year. And so I'm trying to think about how can I reduce my taxes this year because I had a windfall this year, let's say. So if I'm saying to myself, okay, I typically, give away $50,000 a year. What if I decide to sort of pre-fund 3 years worth of donations? So now it's $150,000. So is that sort of the bunching idea where I would take 3 years worth of donations, 50,000 times 3 is 150,000. I put that in my donor advised fund, and now I've got 150,000 that I can take as a deduction in the current year. And that 150,000, I don't have to distribute that all in the current year. I can, write checks to whoever I want over the course of time. Is that accurate?
That's right. That's right. That is a key thing that we look at, and there's a couple of ways to even maximize how you donate into the donor advised fund. I mean, you can put in cash, so just from earnings or however you received it, and that can go in there. But you also could donate appreciated security, so stocks, bonds, mutual funds. I mean, a lot of donor advised funds will take private investments, real estate. Those can be a little bit more complex, but they can take those. And you can put that money in there, put those assets in there. Typically, then the donor advised fund then liquidates the asset. So it's in cash once it gets in there. But the advantage to that is you didn't have to realize a capital gain to generate the cash to then put in a donor advised fund. Because if you donated appreciated security, you're putting that in there, but you're avoiding the tax as a capital gain. So you're kind of saving two taxes in that situation.
You're getting the full deduction for the full value of the security that you might have only paid $20 for, and it's now worth $40 or $50. When you get the $50 deduction, no one ever pays the capital gains tax. I mean, it truly is a win-win.
Now, what about if I'm holding a stock that has a large capital gain in it in my IRA, and so I put pre-tax dollars in there, bought a stock, it's gone up dramatically. Can I then take that from the IRA and put that in the donor advised fund and never have to pay any ordinary income tax on that?
So that functionally is not allowed from a direct transfer from an IRA to a donor advised fund. So what in that situation, because sometimes that there is a reason to take money out of the IRA, but you have to take it out, receive it as income, and then you can turn around and donate it, and you get a tax deduction. Now, there are limits. I think the maximum that you can deduct as a charitable deduction is 60% of your adjusted gross income. So it's not a one-for-one, but these are also, I believe if you happen to go over that 60% amount, you can carry that forward and use it in future years. So you don't just lose it. But in your case, Steve, you're just kind of taking the cash and then getting a deduction for it.
So if you made $100,000, you can't donate more than $60,000 that year to charity.
That's right.
So it's like you can't pull out $1 million from your IRA and donate the whole million and get the full deduction if that's all your income. You can only get up to 60%.
The deduction is limited. That's right.
But under those limits, it almost is kind of like what you said in a roundabout way, though.
That's right.
You could take an IRA distribution and then just turn right around and donate it. And under those limits, in most cases, it works nearly as well.
Yeah.
Does that make sense, Steve, your question and the answer, I guess?
Yeah, but if in that case, is that your RMD?
Well, if you're at RMD age, you should look at first and foremost the qualified charitable distribution.
That's
So
right.
that would just be writing the check directly to the charity. And unfortunately, you can't go to the donor advised fund. It just has to go to a charity. So
And it's only
Okay.
$105,000 per person a year,
Yeah.
too, max.
Okay, so I can go directly from my IRA to the charity and
Yeah.
get up to $105,000 charitable deduction.
that's right.
One
As long as
check,
you're
70
7 and a
days.
half. Yep.
As long as you said, yeah, but I can't go from my IRA to the charitable, to the donor advised fund.
That's right. Yeah.
Right.
That step just is not functionally
It's a
allowed.
bridge too far for the government.
It's a reasonable
Well,
ask, though. It's a reasonable ask.
I mean, it's because it's kind of like it is. There's a lot of similarities to putting it in the donor advised fund. It's just the actual QCD definition is it has to go directly to a charity, and a donor
Right.
advised fund
Okay.
isn't technically a charity.
Good. All right. What other goodies do you have
Sure.
up your sleeve here?
So this last one isn't. I would say it's not necessarily a way to reduce your current tax bill. Maybe, but highly unlikely. But utilizing the gift tax exclusion. So that is the amount that you can give on an annual basis and not have to report it to the IRS. So it's not a taxable transaction. We get this question fairly often that the client wants to give funds to a child and they just want to make sure, well, we don't want to avoid taxes on this. And it's like, okay, well, let's talk about it. I mean, if it's just cash out of your bank, of course, there's no tax consequences. But each person has a lifetime amount that they can give, and that amount is $13.5 million or so.
Yeah, just for fun, I know we're talking about, let's see, 13,610
Yep.
for people who die in 24 and 13,990 for people who die in 25.
Yeah, so they've got cost of living adjustments kind of built into this gift tax exemption amount. And so a married couple, you can double that. So we're talking $27.2 million between a married couple can be passed to whoever, next generation, wherever you want it to go. And if you're giving away money while you're living, well, the IRS kind of wants to know, well, that counts towards the 13.6. But from a reporting standpoint, they said, well, if it's under 18,000 in 2024, we don't care. You don't have to tell us. So that's the annual gift tax exclusion that exists in 2024. And the way that works is you can give it individual to individual. So a married couple, they can each write separate checks to a child and essentially double that amount. Could be up to $36,000 to
And if
each child.
if they're married, they could give
To the
both
spouse,
spouses. So
and then to
72,000.
grandchildren. So you've got a lot of flexibility there to get money out of your estate if that's an issue, or just to provide resources without actually having to file any tax forms. If you happen to give more than that, let's just say you happen to give them $100,000, it's still not taxable. You just now have to report it on your tax return to count towards your lifetime gift tax exemption.
Now, in that case, if you do give 100,000, does only 82,000 apply to your lifetime exemption, and the first 18,000 doesn't, or does the full 100 apply?
Of course.
Yeah, that's a good question. I believe it's the full 100, but I think it depends on how you structure it. So if you wrote two separate transactions,
My argument would be you definitely could give the 18 and it just be the net. That would be my argument.
yeah,
But-
except we're dealing with the IRS here, and they probably just, well, you wrote a check for $100,000, you got to report $100,000 versus this math equation. So I said, now if you wrote two separate checks, I would say you'd be good. But yeah, that's a great question, Steve. I don't know. We'll have to find out. Get back to you.
And since I'm the provider of 2025's data early, it's 19,000 for our listeners in 2025. So it went from
Yeah.
18,000 to 19 in
So
25.
one other question, does it have to be cash that you give, or can I give appreciated stock and not ever have to pay the capital gains on that? I give 18,000 to one of my children, and let's say 10,000 of that is capital gains, and then I give it to my child. do they then get a step up in basis, or how does that work?
So the tax liability would transfer to them. So you can
Okay.
gift it, but then
Yep.
they would be on the hook for capital gains if they were to sell it. So that is,
Okay.
so the tax isn't avoided, it's just transferred.
Okay. So the step up in basis only happens if I die, and then they get my assets after I pass.
That's right. So what Steve's referring
Okay.
to is with these after-tax assets that we mentioned earlier, tax loss harvesting, like if we have a loss, we can harvest the loss. Or if we have a gain, you pay tax when you realize a gain in these types of accounts that aren't retirement accounts. Well, those same types of accounts also, when you pass away, they transfer to either a spouse or the next generation or to whoever. There's a step up in basis at death. That's how the current laws are written. So if there's you bought something for $10 and it's worth $100, if you sold it while you're living, you're paying tax on $90. If you pass away and you leave it to a child, well, that $90 gain just gets erased. So that's a nice. It's something to be aware of, especially as people get older and up in age. Like, you may not want to realize some gains. Now, it's always like, well, should you or shouldn't you? There's always that question. But, let's just be very prudent with our decisions regarding the taxes as well.
So the three of us have been in this business for decades.
Mm-hmm.
And I think during that whole time, we all have been hearing about this massive transfer of wealth from the baby boomer generation and even the generation before them.
Yeah.
That's going to go to the Gen X and the Gen Y folks. Now, that's in like tens of trillions of dollars.
Mm-hmm.
I'm curious, since there is a lot of money out there with your clients, do you see that many of them actually give away $18,000 a year to their children? Do they give out $36,000 because maybe the couple are each giving $18,000? Is it just a small percentage of your clients that do that? Does it vary from year to year? I'm curious. What do you see in terms of how many people actually take advantage of giving that money away tax free?
Sure. Yeah, I don't know if Bill, you want to chime in on that one?
Yeah, I mean, we sat in a meeting today,
Yeah.
just today,
Mhm.
where there was significant assets being gifted to the kids under these limits. But we're in such a fortunate position to have. We've worked with clients. I have some that I've worked with for 30 years, and multi-generations of clients as well. But we've shared on the program before that a lot of the folks that we work with who've done the work up front to get prepared for retirement, to be able to have work become optional, to have enough money to be able to retire and live off those funds for the rest of their lives, they innately have values that keep them from overspending, or they wouldn't be in that position anyway. And so we design plans that are, they're not too conservative. We don't want someone to feel like they're operating under strife, but they are typically living within the confines of the spending plans that we've laid out for them. In a lot of cases, we encourage folks to go ahead and enjoy those resources even more than they are. Early years of retirement, most of our people, some overspend, some we have to reel in, and that's why they have us as well, to tell them the truth about that. But most are folks that we actually want to encourage to enjoy their resources more. No one knows the end date, right? So you have to prepare and think and run projections and really be thoughtful. But most people we work with have more money at the end of their life than they've ever had in their life. They have multi-millions of dollars in their life. They never would have dreamed they had that much those dollars saved and invested. And we really encourage them to whatever is in their specific plan and in their hearts and values, to see that money go to work for them while they're living and not just get dispersed at the end. So again, it's to each their own. But most people that we see in those positions are going ahead, and it might be different per each child too. Like there might be 3 kids that are responsible and don't need the money, but they're getting gifted, and there might be that one that's they don't necessarily trust the resources, and it might not actually help them, and they're not getting that gift, and so it's very different. But we see it a lot, which is really cool.
Yeah, I was just interested on that.
Yeah, and especially as RMDs start to kick in, those required minimum distributions, and there's a lot of times that's more than what people need to live on. And the IRS just requires you to take it out. Doesn't mean you have to spend it, so you can reinvest it in a brokerage account, after tax account. In a lot of cases too, we start to see that's when more of the gifting to family members, children, grandchildren begins to happen as well.
Good. It is kind of funny when you think about it. Like, you think somebody that they die at 89 years old, and their kids finally inherit their money, and their kids are 70.
I know.
It's like,
I hear
wait
you,
a
Bill.
second. And so I'm so fortunate. Like, my adult kids now are self-sufficient, and they're just doing amazing. They certainly don't need me or need my help financially, but
they wouldn't turn it away, Bill.
I don't think
used
anyone's
these strategies
rejected it yet.
These strategies myself, because I'm like, well, they don't need it, but they'll never need it more than they need it now, even though they don't need it. I mean, you know what I mean?
Right.
It'll never be more helpful now.
They could really benefit from it, and they'd really appreciate it when they're still young and can do something with it.
Yeah, exactly. And again, everybody's different situation, but even the next gen that do need the resources, it's a great way to sow into their lives and see it work.
And I think another way to think about that too is, if you are blessed to have an abundance of money that you don't need, it's like, when you give it away while you're still alive, you can see the value that is bringing to other people and other institutions, if you're charitably inclined to give it away to charitable organizations. And so why not get some value and enjoyment of seeing what you've worked for, help other people while you still can, instead of after you're gone and you have no idea. Well, what's my money doing? I'm dead. I don't know.
Exactly. It's a great combination of things to consider, for sure.
Yeah. All right, Matt. Well, thanks for sharing those ways to lower our taxes here before year end. And Bill, why don't you take us home here? Any final thoughts for today?
Well, Steve, you can see clearly, I think, by some of the questions you were even asking us, and you're a CFP. I mean, you're a professional in our industry for 35 years.
I'm the voice of the listener here.
That's right.
You are. I love it. It's wonderful. Like I said when we opened the show, I hope you continue to be that voice for us here for many years to come. So, but you look at the timing around some of these things, the details, the limitations, the tax deductibility here but not there, at this time but not that time, and you look at how this all works for each couple or person individually, and how they work together, and you start to see, and as we say every time, almost every show, having a plan and thinking through these things. I mean, we're talking now here in November about things to do before the end of the year, which is good. There's still time. But these are things you need to be thinking about, not only early in the year, but we need to be thinking about these things this year for what you might be doing 5 years from now, even. Like, really having a plan in place for the current year out into future years. And you can see the pivot from, donor advised fund for most folks makes a lot of sense for a certain time. And then all of a sudden, Roth conversions too, which we didn't even talk about today, but that's another little aspect to how this stuff plays together. We can touch on in another episode. But then, we need to maybe shift over to our QCDs, which was a question that you naturally asked and Matt answered. Well, no, maybe QCDs now is what we shift over to at that point in life. And maybe the donor advised fund, not as much, or maybe so, depending on the situation. But it's I love talking about it. I love laying it out there for folks to at least pique your curiosity. And I would just simply say, have a plan, not just for this year. Certainly don't just look at everything in April and report history of what happened the prior year. It's highly, highly likely you're going to have missed opportunities and possibly even had penalties and other bad effects. But really have a plan that helps you think ahead with a competent fiduciary professional that can lay these things out in a format that's understandable, that aligns with your values and your intentions, and make the most of your resources. Be a good steward of your resources by doing those things. That's always going to be our message, I think, on our program, you guys. I really do. So looking forward to the next episode. Yes, sir.
Excellent. All right. Well, thank you, Bill. Thank you, Matt. And appreciate each of you listening to this. And if you like what you hear, please make sure that you share this podcast with all your friends and colleagues, and feel free to rate the show from your favorite podcast player or app. And we appreciate that. You can always go to keenwealthadvisors.com to get all the information on this episode and all the other ones, and reach out to us as well. If you have a question or want to have a conversation with one of the great advisors here at Keen Wealth Advisors. So again, appreciate it. And we'll catch you on the next episode of Keen on Retirement.
All right. Thank you.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.